Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. In this episode, I'm interviewing Angus Cameron, the Chief Investment Officer for GHM Family Office.
This is the Family Office Sherpa.
All right, welcome, Angus. Thank you for taking the time. I do appreciate it. This is the second in the series of interviews, so, you should think yourself very lucky.
Disappointed.
My thematic here is scaffolding, right? And really around that support networks and things like that. But first of all, I'd really love to hear your overview of the GHM family office, where you're based, really concentrating around sort of, what's the purpose here and really some of the structure as well would be great.
Thanks, Shaun. Disappointed not to be first, to be honest, especially with my background. So I sit in a family office, as you say, called GHM. We're based in Sydney. The founder, principal, ran hospitality assets for 40-something years, from starting in restaurants and into resorts, built a couple of resorts very well-known resorts in Fiji. Became one of the kind of key Westerners in Fiji, which is a very interesting place to do business and actually frames a lot of how we run our business now. That was exited into 2013-14. GHM is a moniker that we know what it stands for. It's deliberately vague in that it makes it very hard for people to find us. You know what it's like being tapped on the shoulder all the time. When there's money to go out, everyone will try to tap that shoulder. We went through a really interesting kind of period early. So the principal, who is the G, he ran a business that was extremely difficult given the style of how Fiji works. It's a jurisdiction that obviously has slightly less rules than we do in Australia, and you've got to really know where everything is. You've got to know where your money is. You've got to know who's good and who's not. But typically everyone's trying to kind of scratch and claw and take those dollars off you. When I came into the business, as the main assets were being sold, I had a great relationship prior to the formation of the family office with the founder. But I came in with a very institutional mindset. I worked for a couple of banks and brokerage houses. I came in trying to institutionalize, or wanting to institutionalize, because that's what I figured was the best thing to do. What came really apparent over the first couple of years is that the founder couldn't care less about that institutional side, and that really didn't gel with him at all. And so while I was trying to, put really tight frameworks around rebalancing and institutional style of allocation, really based around that endowment model, I could see that the eyes would glaze over every time I tried to go with that reasoning. And after I kind of got out of my own way and realized that what I did, no one really cared about, was this was someone else's money, and he wanted to be engaged, and I wanted him to be engaged with it, because there's no point in making it if you can't enjoy it. And so for our own purpose in the office, we kind of started from scratch. And after a period of time, kind of the boss said, "Look, what do you want to do?" And I said, "No, mate, it's your money. What do you want to do?" And he went, "Well, no one's ever asked me that." And I realized there's this massive chasm in that sort of ultra high net worth to family office, like first generation family office, where no one asks that question properly. Or if they ask it, they don't actually care what comes out, because typically that wealth is shepherded into a variation of the 60-40, generally by the wealth management groups. And that can be fine and has been fine. I would assume that those principals are there for the blue ribbon on the door and makes them feel comfortable. But the boss has been doing business in Fiji for 40 years. Comfortable is not really in his DNA. So we spent a couple of years talking about what do you actually want it to look like, and that was like blood from a stone. So trying to get that information out in terms that made sense to him was really formative for how we do things now, more than a decade later. But realistically, it gave me the ability to write a framework from scratch, which we can adhere to under our own terms. And it means that I don't really care what anyone else does, and that took a long time to get comfortable with, because I was pretty green. Some would argue I might still be a bit green in some bits, but once I got comfortable that we could make our own mistakes and we could do it as long as we lined up with our own framework, that's not the worst thing in the world. And it meant that I kept the founder engaged, and then we sort of started to embark on what that next generation looks like and how we would embed this as a business that ideally, we can see the next couple of generations through while I'm still alive and kicking, and how that looks for the kids that are coming through. They're in their 30s now. So we sort of started from that point. That first 5 years really felt like, looking back on it, a feeling out stage. And we've really got a rhythm now as to how we do things, what we do, what we look at, what we don't. Much quicker to say no, much easier to say no, because I know what fits and what doesn't really firmly, and has freed our arms up to do much, much more spicy things, I guess, because I've got the core of it right.
So I think it's a really unusual setup in that, it's almost this, can you just give me a little bit idea around if there is any governance framework in there? You mentioned that there's the primary objective was to manage the assets in the way that was in line with the founders or the principals' thinking, right? And as you say, it's really hard to sort of go from that more institutional mindset. Oh, hang on, we should have 60-40. We should have liquidity here. We should have asset class diversification, all this cool stuff. But if the principal then goes, well, none of that is what I want to do. Once that principal relationship changes, or some version of that, right? What does the iteration look like? Do you rely on? You're the chief investment officer, right? But you really are the chief of getting stuff done, or you're the person that sort of does everything. What does that look like now? What does the next iteration potentially look like? Are you going to rely on a bit more of a governance structure, or have you been given the agency to go, well, we're just going to continue with this, and because this is what the office is set up like, and this is the way we continue to go forward?
Yes, the governance structure just needed to be a bit different than what I'd kind of expected it to be around asset allocation rebalancing. Primarily when we went through the first couple of years of, it was a slow interview process in that it wasn't that prescriptive, and it often involved Pinot Noir, but we would sit down and at the pub, and I would try to squeeze out very slowly information as to what he actually wanted in his terms. And I would then try to rework that in my head as to what that meant in a framework. Being a guy who was very, very commercially able, he wasn't necessarily educated in the sense that he finished school at 16, he went and worked on the land, but he just had a knack for doing things. When he started his first restaurant, he was cooking, serving, doing the till, the whole lot. I wasn't alive then. And from what I understand, he would have queues out the door because his ability was unbelievable. So if you've got a commercial mind, and I'm coming from the finance side, then there's just no obvious correlation between those two sets. Once we broke it down, what he wanted was that his next generation, there is only one generation at the moment after him, he wanted them to be looked after kind of regardless of scenarios. So in a zombie apocalypse, what does that look like? And so in practical terms, that is, what does a pool of cash or a pool of money look like that is very, very hard to lose, that may include the family property, but realistically is cash and cash-like. That is there, and that is almost siphoned off to the side. And so it's there, and I can't make a meal of that bit. I can make a meal of the rest of it. Then we had the return generation side. So we obviously have to make money at some point. We've got to pay for the office. We don't have a legacy business anymore. And then there was this, want to do things that are a bit more, hairy, for want of a better term, because in the end, he was a risk taker. Like, he was a very good risk taker, but only when he had control of it. And so I had to figure out how to put those puzzle pieces together. There's a book written in kind of 2006, I think, called The Aspirational Investor. I've seen it pop up a little bit more in the last couple of years. I don't know, I can't remember how I stumbled across it, but I stumbled across it. That really simple framework of 3 buckets of risk gelled really well, and I could explain that really simply to him. Say, well, you've got 3 buckets. One is preservation, the next is market, and the next is aspirational. The preservation bit, that's our zombie apocalypse bucket. The market bucket is where we kind of generate our returns and broadly pay for the office and pay for the family and all that sort of stuff. The aspirational thing is where we can have a bit of fun. Within those, we then break them down further. That's changed a bit over time, but I can explain those. But we've got that framework at its very core was something that was the kind of very early piece of work that we did, was those broad frameworks, and then try to tie some more detail through that. So how those were broken down, I guess you'd say. How the preservation bucket is pretty straightforward. The market bucket can really take on most things, like all the private equity and cash generated businesses, anything with beta, any market stuff, any hedge fund stuff, that can all fit in there. So the next job was really, that was the bulk of the allocation. It's north of 75%, I think. That's the bit that needed a whole lot of work around how that is put together. Jeff's main fear was really that he would lose money and lose a lot of money. And that was that classic loss aversion bias. Over time, it was very clear that if I went and read any behavioral psychology books, which I then spent the next 2 or 3 years doing, and trying to understand how he was thinking, because I could lose a couple of $1,000s and I could make a couple of $1 million, and I know what I'd hear about. I'd hear about a couple of thousand over and over again. And so there were all these little parts to that we had to weave into the reporting structure, the governance structure, and the overall portfolio. And that took a heap of time and a heap of trial and error to get it into a point that we were happy with. From there, a lot of it was around, right, how do we take the personality that actually generated this money? Family having for me to say that the principal died late last year. So we spent that 12 months leading up to that, given we knew it was coming, writing a legacy piece that was aimed at respecting what he'd done in his life and in his commercial life, and how we tailed that through to the portfolio. For context there, he made his money in Fiji by being very good to the Fijian people. You can go to his resorts 20 years apart and the same people will be there. He treated them not like commodities, which can happen in hospitality from Westerners owning assets, but like family. And so when his staff were getting older and starting to get to the end of life over the last 5-10 years, we knew who was looking after them and making sure they had a comfortable end of life. And so we tried to deal with that in an interesting way, in that we try to face the street as very happy and friendly capital. So I see a lot of family officers who kind of jump down people's throats when they lose money or make a mistake. We try really hard not to be like that. It's my job to find the right people and make sure that we can back them and back them again and back them again. And my understanding of being pragmatic about how we lose money or how I lose money, and knowing that I make mistakes, is as long as I'm finding that right person and they can make a mistake and we're fine with it and we understand how they got there, that's cool. And we can deal with that. It's, making sure that we got the right person in the first place. But we want to, help people run their business, be genuinely helpful with introductions and all that sort of stuff, and all karma-based, no fees or anything like that. And it's something we worked really hard at. And, we've got the data within our portfolio over more than a decade that tells us where we should be and where we shouldn't. And so we respect that. We're really pragmatic with that. I'm really pragmatic with what I'm good at and what I'm bad at. And all these things have fed into the framework and governance that we run internally.
Yeah, it seems that the entrepreneurial spirit it was in the DNA of the office still, right? Like, it's still very much like you said, you have those 3 buckets, but do you find that, one of those buckets takes up more of your time than others? And, is that the way it's intentionally structured? So it's like you said, you have those 3, and the fun or the hairy stuff. I'm imagining, my personal experience anyway, that direct, that more entrepreneurial, higher risk but higher return bucket tends to take a little bit more of your bandwidth. Do you set it up differently? So you manage a lot of you have a significant manager base geographically, as well as asset class and things like that. How do you, if you can talk about the team and the support network that you have around there, that'd be super helpful. Because if I think about all the things that we talk about, in my head, I'm just like, I don't know how, there's a lot of balls in the air there. How do you manage that? Do you rely on others? How do you find managers? If you can just talk around sort of that, maybe your day to day and week to week kind of thing, like, where do you find them? How do you manage them? And how do you manage that internally as well?
Yeah, well, day to day, I dropped the kids off, went for a swim this morning, so that was good. That's often the good measure of how we do things is what I'm doing day to day. The bulk of the portfolio is set up and it should relatively run itself. I shouldn't have to touch that a whole lot. We went through that kind of overly touchy process early. And again, that was me being used to being on a screen for my whole life and kind of wanting to be overly fiddly. I've burnt that out of myself. And now it's really about sizing correctly and making sure that we can continue to back people over a longer period of time. On the entrepreneurial side, I would say at cost 2 or 3% of our capital, takes up 85-90% of my time. And that is how it's designed. And we're perfectly comfortable with that. The convexity that we get out of some of these things, and we will write the ticket that no one else will write. Very, very clearly, we are first money in the stuff that we do. And that can be managers as well, in a certain macro that we're trying to face into. But as far on the entrepreneurial side, it's the person, the PowerPoint, and that's got all sorts of problems with it. But I know from experience that what the deck that I'm being shown is highly likely to be wrong, and 6 months will change. The person on the other end of the deck might not know that, but I can help them with that. And so we will, if we can get comfortable with the person, comfortable with the macro and the tailwind that they're facing into, you're providing small amounts of basis points into single-digit millions valuation companies, and ideally they're becoming large. Now, if there is zero, I lose more money in that in currency probably every day. And that's how it is. If they're not, then we've got endless duration to sit and watch. Ideally, what we do is we give that person a lot of my time over a couple of years and see if we can get them from person and a PowerPoint to some commercialization, more of a commercial backing and background, and get them to, corporate life almost, or to commercial life where they have a chance at becoming something. It does a couple of things. It puts us in some rabbit holes that are really interesting and really good fun to go down. They teach you a whole lot of stuff that you've never come across before, and that's just enjoyable, right? I, can talk to FX people and I can talk to markets people, and you just hear different opinions on the same thing, and that kind of over time can be a bit dull. We've got a business that's building, agave feedstock for biofuel. We've got one building digital twins for agriculture. This stuff that is super esoteric and has taken years, or some of them taking years of work, but I wouldn't see them in my normal day-to-day, but it gives me a couple of things. It makes me look down these kind of avenues of returns or other businesses. It can help me with investments that we're doing in that space. So if we're looking at something very early stage in a certain space, I then have the access to probably all the managers in that space and figure out if they know what they're talking about or not as well, because I can kind of see right down the other end of the spectrum. From that kind of 90 or whatever % of my time that goes into that, other things come through. We use our network well, in that my network involves a lot of family offices who know that we're not a commercial advisory business. And if I'm sending them something or asking for something, there's no real benefit to me or us in that way. We're not trying to drag a fee out of anyone. We are literally just trying to help them. I see that as coming back to me over time. We've got friends in family offices in most parts of the sector spectrum. And so if I can't figure something out, I can ask by a quick call or a text, pretty much anyone, and I'll get an answer that comes from the right place, as opposed to someone trying to sell me something.
Yeah, and I think that brings up the family office network effect, right? And it's not just investments, in my experience anyway, right? There's all sorts of different things that you can tap into that network. Are you finding that the family offices that you talk to are having similar challenges in this space? And let's bring this back to, say, maybe the infrastructure piece, right? Because you're a sophisticated, and you've been around a while now, right? And I'm assuming that you've made some infrastructure steps that have been have done well, and some that have been potentially a bit challenging. You might have to step back and look at something different. That infrastructure. So, and when I'm talking infrastructure, I'm talking potentially investment reporting, right? So getting that data, you mentioned, getting the data before, getting the data around your investments, those three buckets, what does success look like and how do we measure it? Can you talk around maybe a little bit of the tech stack or the operational piece that you have set up? What's working well? What's being challenging?
Yeah. So when we started, we probably went a bit hard on the infrastructure and the reporting requirement that we needed, because I was trying to institutionalize everything. And we were spending a good chunk of change every year on some reporting out of the States, which was great for, a multi-billion-dollar multi-strat. That's not me. And, once I've played around with it and I love my numbers, I realized I was probably only using, 10 or 15% of the capability realistically, because the family that I'm reporting to just didn't need it. And so I could spend all the time in the weeds and playing around with things, but realistically, I was still trying to report to the one family. And so we need to simplify that, more kind of visual and, a software tool that could be easily used. When I got a little bit lucky / a lot lucky that when COVID hit, the second generation was working in hospitality in Whistler and realized that was not the greatest place to be when COVID hit, and he came home. No real idea of what he was trying to do, but he, he's a very hardworking guy and decided to put himself through some machine learning and some data courses. He actually built us a backup backend for all of our reporting and dashboarding. We've built some quant systems that feed into our kind of absolute return multi-strat that we have internally. And so all of this stuff that I'd been scratching around the sides of over, at that point, 5 or 6 years, that was, 3 out of 10 in quality, suddenly became really good. And it was beautiful. We've got liquidity models and we've got data models that tell us who's reporting, who's returned, and who's not. I could then use the simplest side of the outward-facing software to provide very simple family reporting. So in the family, there were 4 family members, 2 in the older generation. One obviously passed away last year, and then the 2 kids. Now, one of the kids is suddenly in the office working with me, and one is completely on the other side and no interest in how all these things work, and that's cool. So we had to kind of cover the void of, I had 2 people in the office with me all the time and 2 not. 2 were interested and 2 weren't. And how do we kind of communicate through that? So we punch out all the data we wanted, but 2 of them just had no interest in it. And so I'd be, having all the numbers with me, but then I'd be trying to communicate them through a written piece every quarter that was not dumbed down, but it was meant to be more interesting for the layman. And so I was trying to pick up whatever dumb stuff was going on in markets and these ridiculous things. And, 2021 was great for that because you could talk to short squeezes and this insane investor behavior. And that was fun to write about and talk about. It allowed me to, I could report on the portfolio and provide some simple screen or some, portfolio return imagery while I could talk about, Elon Musk doing illegal things and all this stuff that was more interesting than saying, BHP went up 10% this month. And so trying to cover that divide in a, thoughtful way that everyone could engage in, that we could then sit down with the family and go through any questions that they might have to try to keep that, half of each generation engaged was pretty important.
Yeah, and I guess that brings up another point too, right? Which is, where does that next generation engagement and I guess to a certain degree your redundancy sit, right? So if I hear about your office, there's not an insignificant amount of it being driven by yourself, right? The investment piece, the IP transfer from the direct businesses, but also obviously, a significant amount of skill and career capital that you bring to it. Now, it's a pretty flat structure. So as far as I understand, it's you and one of the next gen in the office with you. Is there, what happens there? Like, is there other people within the office that you can rely on? Is this, I guess it gets to this in-source, outsource piece, right? And what that looks like for resilience, for one of a better.
Yeah, we've got a partial CFO as well, who's an ex-senior partner of one of the big 4 accounting firms, who's a great resource to us, and again was almost part of the family. Had worked with the boss for 40 years, starting in Fiji. He provides a lot of that redundancy and that extra kind of signature and that extra part of the IC. So we run things for him to try to make sure that we're hitting those points. But yeah, there is no doubt some internal IP, I guess, in how he built things. So we have tried to make sure it is all out of my head and onto paper. I had not an insignificant health thing happened probably 4 years ago now. For about 12 months, I wasn't confident that my brain was working that cleanly, I guess. And so there was a chance that I was going to have to kind of pass on some of my duties. We've tried to be super open with when the second gens come in, there was no semblance of me trying to hold anything back as to how we think. All of the reasons we do stuff is documented how I got to a decision is documented. So I know what, also if anyone comes in after me, they can see what we're doing. I mean, if they looked at the portfolio line by line, it may or may not look like a dog's breakfast. But if you pull it apart as to why something sits where it sits, everything's got a really good reason that it's there. Now, whether someone that comes in can then go through the process that I went through over years to break it down differently to, why would I do this now? Then that's another story. And I guess that's up for the current boss to kind of drive that through. Ideally, if I do this for another 20 or 30 years, at some point I can find someone younger and prettier than me that can come in and we can really walk through, this is how we would like to think. If you've got another way to do that or another way to look at it, then, we will trust you to do that. But that's going to take a bit of time and trust, like we do with everything. It's very people facing.
So it's interesting because you've got this very entrepreneurial component of the office, and then you've brought an institutional mindset, realized that potentially that needed some flexibility, right, in terms of the way that you invest and the way you engage with the principal and the investments and the reporting piece. Like you said, you've got engaged and potentially less engaged second generation. So these sort of moving parts. But then you've also got this process-driven follow-up, right? So if I'm hearing you correctly, what we've got is a really flexible office, but we've got one big driving bucket in the middle, which it looks, if you brought any sort of, similar investment professional like yourself, they would go, I understand what that is, right? There's a CPI plus version, there's liquidity requirements, we know what that looks like. This stuff, the hairy stuff, the more interesting, that's probably idiosyncratic to the point where there might be some, I'm not really sure or whatever, but it seems to me the way you've structured the investments is you do have that core and that risk part that looks relatively straightforward, but then you've got this other aspect, which is the engaging and, like you said, takes up 85, 95, 90% of your time. Is that fair? Like, is that way if you looked at it on like a bucket, like those three buckets, would that look like that?
Yeah, so the core is a mix of liquidity requirements and office requirements. As I said, we need to actually pull money out to pay for things. So we don't have that legacy business that's just pouring capital in all the time. So we can cut that bucket up in a number of ways. I realized at some point that the boss might want to buy a hotel, for example, at some point in his time. And I couldn't really push back against that. That's just how it was. And I was sort of, again, very pragmatic and got comfortable that could wipe out my job forever. And that's just something that was going to happen. So what we actually needed was to have enough money liquid in case of emergency. And given the behavioral psychology nature of who I was working for, he might have just said, bugger this, I'm out. I don't want to touch it ever again, red button. And I just had to deal with that. And so if I was 75% illiquid PE alts and private credit and stuff, I didn't know where that was going to sit. So we had to build a liquid and semi-liquid bucket, which looks like a multi-strat. We've built our own kind of quant function that is a testing engine for us. That's liquid between 2 days and a quarter, depending on what's going on in there. It has 5 or 6 liquid managers in there. That is a reasonably good chunk of that middle bucket because we can move it around quickly if we need to. That was a real exercise in what an outcome-based liquid model should look like. And for us, that is, high single, low double digits through any cycle, positive as much as it can be, but very low drawdown because I didn't want the boss to, lose over it. And so that's been going for, a lot of years now. It typically does between 8 and 13. We said 8 and 12, and it's like 8 and 13. Its drawdowns are like 2%, does its thing. I can't argue with that, and that works really nicely. So that kind of takes that up. When we started doing this in the mid to the 2010s, rates were zero or approaching zero, working for a boomer who liked to see yield. That was going to be an interesting problem. The only thing we really ever butted heads about was taking on too much of that cap rate risk because things were super tight and I wasn't comfortable with it. But we got through all of those pieces and the flexibility of the non-endowment model, I guess. The flexibility of what the structure that we built meant that if we didn't want to be exposed to something, we didn't have to be. And so when rates moved, we didn't have any exposure to it, which was awesome. We had a little, so not none, but there was very, very minor risk when rates went from nothing to a reasonable amount. That was a pretty handy thing to do. And then when we went through, 2022 was very different to 23, it was very different to 24. We had broadly the same P&L in all of them. And that's what we were after, is that test. Now that obviously can change pretty quickly and markets can change. We don't try to pick up growth cycles. I know I'm not good at it, so just don't. Like, people can go and throw darts at NVIDIA now if they want to. I don't lose sleep over not having anything in that area because I just can't understand it. I don't necessarily want to.
Yeah, and it's, I guess, one of the great things about being sort of the chief investment officer here, right, is that you can lean into your skill set and you can lean into what you know and what you're comfortable with without sort of, the classic client base or wealth management client base demanding some version of it, right? So you can be, what the best thing about single family offices is, right? You are very specific to what you want to do. Like, there's not a lot of restrictions on the ways that you want to invest outside of, I guess, what success looks like for you and the family, but also, I guess, some feedback there as well.
Part of that would be, I also try to put guardrails around myself so I don't do all the stuff that I want to do. If there is something that I just think is the greatest thing of all time, I'm just going to keep doing it all the time, and then my risk gets skewed. And so I put within that kind of core portfolio, we've got some more thematic kind of silos. By themselves, they can have a kind of multi-strategy feel in that there can be some illiquid, some liquid, some long short, some private assets in there, but they all kind of pull together and we test how that would look together. They're in there partly because, it's much more interesting to go down those little research holes to figure out what's going on in the world. If there's something that we want to be exposed to, but we don't know how to time it, if we can get that piece to work, if it doesn't work, it's not a massive drag on our capital. Like, if it's flat for 5 years, then I'm wrong. It might be 5, 8, 9% of the portfolio overall with all the buckets put together. I can kind of wear that not doing anything. As long as it's not a zero, then I can deal with that. That gives us that, again, a little bit of that flexibility. But my view on the world at the moment really is around stuff, and that we've got an asset, we've got a silo called real and productive, and that can involve all sorts of things in there, including agriculture and mining assets and all sorts of stuff. I think that is one of the better parts to be in over the next 5-10 years. However, it's very cyclical. Some of those assets can be very, very cyclical. I can be wrong for a long period of time. So I prefer to put some guardrails around myself so I don't just go and buy, completely load the truck up and then get swung around every quarter and start to have to move that 10% of my time I get to spend on that, and that suddenly becomes 60. I don't want to do that.
So you talk about your own personal guardrails, right? So it's almost like you're self-regulating a little bit here. So where's the role? Is there an investment committee? Like, is there a role there? Is there a team there that sort of goes, all right, Gus, like, this is on a quarterly basis. This is the return that we've got. This is our liquidity profile. It's matching our investment policy. Is there a governance structure that sits above you that, I guess, determines the efficacy of your management?
Yeah, so that's all coming in while we're doing it as well. So if I'm doing most of the actual investment work, that's been communicated consistently between me and the boss kind of all the time. So we know it's within the framework as we go. The further I see adds the CFO to it, but it is something that is just happening constantly through the period. All of that testing, all the data work and the sizing is done, as far as self-regulation goes, it's more that I've written it into the office that it is there to keep me under control, as opposed to it is written, and if someone else came in, then it would still be written. It's not me kind of with my finger in the air going, oh, is this good for me or not? But yeah, the rest of how the IC kind of functions, 75% of it is almost done week to week. Like, we are constantly working on that sizing, whether something fits, whether it doesn't. By the time it gets up through there, then 95% of that decision's kind of made.
So it's an interesting sort of thing that you're finding. Well, I'm finding, and I'm not sure if you are as well when you talk to other family offices, that having something written down and that can be lent on, as opposed to something theoretical or spoken about on a quarterly basis, is actually much more powerful in terms of saying we've got a really robust procedure here. Like everything we do is, written down and we are following it. So we don't necessarily need to have that quarterly cadence or that whatever that might look like. Some do because there's a lot of different moving parts, but some like yourself and a few others. So we rely on that investment policy and that governance structure to really guide us on a daily basis almost, right? So that brings us to one of the last questions, which is you talk to a lot of officers, you meet a lot in Australia and globally, right? You talk to a lot of people. If you had to sort of say the number 1 and 2 trends that you're seeing in terms of the way that family offices are set up, importantly, like are you seeing something where it's like, well, maybe 10, 15 years ago when we started our office, we're now seeing this. Like we're starting to see a lot more people do this. Is there anything you can reflect on that?
Yeah, I think a lot of particularly around the first gen officers come in with a fair bit of excitement and try to do a bit of everything without having that kind of framework set. It feels a bit like dart throwing. And it can be because we did it early as well. Like we got money with a manager. Manager says, this is a great trade. Would you like to co-invest with us? And we would, follow that along based on the manager. Now, the manager's got the same amount of idea that we do, really, whether it's going to be successful or not, which is bugger all. So we kind of I still see that with some of the other families in that I think they're taking on trades that they probably don't need to, or they don't, and mainly they don't size correctly. So if I've got a concentrated equity manager, just for the sake of round numbers, and you've got 10 positions, and I've got $10 million with them, and they say, oh, you should buy more BHP. They've already got $1 million of it. Why am I taking that position on again? Just because it gives me visibility. It makes me feel like I'm in control when I'm not. It kind of it's probably that control thing. Like I'm wearing big boy pants, I'm in a big seat. I didn't need that in the end. Like I realized that I don't really care what everyone thinks about me. And I do see a lot of positions that are not meaningful in portfolios, particularly around size. And that if I take on X and it triples, why? Like it doesn't matter. It adds such a small amount for that risk that I'm taking. It adds admin, it adds all sorts, and we don't need it. And so we carved out a lot of that, particularly later stage growth and in privates, because I can't size them. I can't put them in my models and make them make sense in any way. And it all kind of rang true and has kind of worked relatively well over time. But we just got happier to be where we belong. For the other families, a lot of them, I think, are in spots that they don't belong. It takes, I don't know, some of them won't ever actually come to that realization. But I think a lot of the early guys will kind of do a bit of everything, maybe gradually scale them back. But often those early mistakes create real mental blocks and kind of stops you from doing anything. And then there's the evergreen bias of Australia into property and things that have always worked. And that lack of risk understanding that cycles can be very long and very slow. And it doesn't mean that property as an idea is going to get cut in half at any point. But what if it went flat? And so we do a lot of what ifs. What if something didn't happen over a long period of time? You've got groups who just do it hand over fist because it's always worked. It's always worked because rates went from, whatever they were, 19% to blob over 40 years. It's a pretty good tailwind. And so I think that bias towards certain asset classes because they've always worked is something that takes a while to work out. And so having framework and infrastructure that takes you away from those biases at least, or sizes those biases correctly, is more important than most realize.
Excellent. Yeah. We are, pushing towards that part of the cycle too, right? And it's always interesting. And you mentioned at the top of the call, when the principal saw red and green, right? When we saw a big loss or a big gain, you knew which one you were going to be talked about more, was going to be.
It wasn't a big loss. I'd say the small loss and the big gain. I hear about the small loss. I'd never hear about the big gain.
Yeah. So, and I guess that's something I think there is some version, not necessarily of a reckoning, but certainly people are going to go, well, how do we articulate? How are we going to framework this? And, the things that are coming out at the moment around the resilience of portfolios as opposed to the growth of portfolios, and you talk about when you do the investment policy and the framework, it's like, everyone loves it when it goes up and everyone's having a great time with every asset class and all the rest of it. But how are we going to manage that downside conversation with principals that potentially are not used to seeing red, or not so used to seeing, like you said, some version of a flat return in an asset class that previously was giving them IRRs of, double digits and without a significant amount of what they perceive to be risk, right? So I think that, and I'm finding that as well with the communication and like just being able to, what are we going to talk about when we don't get our 10% return on equities that we've got for the last however many years. I think the last question, which I'm going to ask for everyone, which is there a charity that yourself or the office would like to highlight for this podcast episode?
On the office side, the boss was a great supporter of the Royal Flying Doctor Service and contributed plenty of money over time to that. We support some smaller stuff over in the Pacific Islands. And on my side, one of my close mates runs a charity here called the Bondi to Berry, which is a dementia-based bike ride that was done last weekend, actually in mid-November. And he's raised significant funds over, 5-10 years, I guess now, for the Bondi to Berry. And so Nick Young does a great job in that. And anyone that rides a bike and likes the coast, next year, he'd love to see you, I guess, on that in late November.
So Bondi to Berry being Bondi, obviously people know where Bondi is, hopefully, and Berry being?
A small town in sort of southwest of Sydney near Bowral.
Excellent. And we can find that on a website, I'm assuming, if we Google that.
Bondi 2 is a number, Berry.
Excellent. Well, thanks very much, Gus. I really appreciate your time today. I know you're not a LinkedIn poster. I know you give people hassle a little bit about that. So I'm assuming that we're not going to do that. But I think, like you said, you've got a unique office. Hopefully today, for a lot of people listening, can get an insight into sort of maybe, like you're talking around their resilience, but also being able to communicate up to the principals and to manage assets in a way that the principals are comfortable with, whilst also sort of retaining some version of that institutional endowment style model. So thank you very much.
No worries. And happy to, we're pretty open. If people do want to reach out to me, I try to avoid LinkedIn desperately, but if you do find me on there, I try to hide myself a bit. Then feel free to yell out, and we are quite happy to talk about portfolio construction and the stuff that we've learned over a reasonable period of time.
Excellent. Thanks, Gus.
Thanks, mate.
And that's it for this episode. If you're interested in finding more about the Family Office Sherpa, go to thefamilyofficesherpa.com. Until next time, thanks for listening.